You sent your daughter $15,000 to help with a down payment. You Venmo'd your grandson $500 for his birthday. You wrote your son a check to cover 3 months of rent while he got back on his feet. Private transactions, family business, nobody else's concern. That's how it used to work. In 2026, the IRS now runs 129 active artificial intelligence programs, more than double the number operating just 2 years ago. Those programs pull live data from every bank, every payment app, every brokerage account, every mortgage company, and every state tax agency in the country, around the clock, every day of the year. Their function is singular. Identify transfers the IRS believes should be classified as gifts, should be taxed, or should at minimum be explained. If you've been sending money to family members under the assumption that nobody was paying attention, I need you to understand something clearly. Somebody is now paying very close attention. And unlike a human agent who might miss a pattern across 3 years of bank records, the algorithm misses nothing. This video will show you exactly how the system works, what it's looking for, where families make the mistakes that put them in the audit queue, and the 5 completely legal strategies that keep your family's money transfers entirely out of the crosshairs. The IRS doesn't operate a single surveillance system. It operates 4, each designed for a different type of taxpayer, all drawing from the same underlying data pool. System 1. The Discriminant Function System, DIF. This is the oldest of the 4, running in some form since the 1960s, but the current version bears no resemblance to its predecessor. DIF scans every personal tax return filed in the United States and benchmarks the numbers against statistical profiles for people who look demographically similar to you. Same age range, income level, zip code, occupation. If your deductions shift significantly from one year to the next, if your bank deposits don't align with your reported income, if you're consistently filing round numbers rather than exact figures, DIF flags you, not to a human agent, but to the next algorithm in the chain. System 2. The Individual Taxpayer Model. This one is newer and considerably more dangerous. Rather than analyzing a single year's return, it evaluates your entire filing history, 5 years, 10 years, 20 years if the data exists. It doesn't just flag potential problems. It actively recommends the 3 specific line items on your return most likely to yield an adjustment if an agent opens the file. In practical terms, by the time a human auditor ever sees your name, the IRS already knows exactly where it intends to look. System 3. The Line Anomaly Recommender. Relatively new. It replaced the previous method for selecting high net worth individual returns for audit, specifically those reporting business income, partnership income, and real estate holdings. Rather than examining individual figures in isolation, it analyzes the mathematical relationships between every line on your return, comparing those relationships against what should logically cohere. Depreciation that doesn't match your stated asset base. Partnership distributions that diverge from your capital account. Any internal inconsistency gets flagged. System 4. The Large Partnership Compliance Model, the most aggressive of the 4. Before this system was deployed, the IRS flagged roughly a handful of large partnership returns for audit annually. After it went live, that number surged to 82 flagged returns in a single year, an increase of anywhere between 10 and 100 times the previous rate. If you hold any interest in a family limited partnership, a family trust, or a pass-through entity that holds family assets, this is the system actively monitoring you. All 4 pull from a single unified database the IRS calls the Compliance Data Warehouse, containing every deposit you've ever made, every employer filing ever submitted on your behalf, every 1099 the IRS has ever received with your name on it, every payment app transaction flagged to them, and every suspicious activity report any bank has ever filed against your account. No warrant required, no notification required. The IRS doesn't have to tell you the data exists. It simply does. Here's a concrete example of how this plays out in practice. You've been sending your adult son money over 3 years. $10,000 at one point, $15,000 at another. Some of it in cash, some through Zelle, a few Venmo transfers. Everything felt informal. Everything felt private. 6 months later, your son walks into a car dealership and puts $70,000 down on a new truck. The dealership files IRS Form 8300 reporting the cash portion of the transaction. The title company transmits loan data to the credit bureaus, which the IRS scrapes independently. Your son files his tax return showing $42,000 in annual income. The algorithm now sees a straightforward mismatch. $42,000 in reported income. $70,000 deployed as a down payment. No inheritance on record. That's a lifestyle to income gap. It gets flagged automatically. From that flag, the system traces backward through your son's banking history, searching for the source of those funds. That's precisely when your Venmo and Zelle transfers to him start appearing on the screen. The algorithm doesn't process the fact that you love your son. It processes the pattern. Once it identifies the pattern, the case enters a review queue. By the time a human agent looks at the file, your entire 3-year transfer history is already laid out in front of them in a clean chronological table, organized, sourced, and ready to be acted on. The annual gift tax exclusion for 2026 is $19,000 per recipient. That means you can give any individual, a child, grandchild, niece, friend, up to $19,000 in a calendar year with zero tax, zero reporting, and zero filing requirement. Married couples can double this figure by electing gift splitting on Form 709, raising the per-recipient limit to $38,000. Give your son $38,000 this year and completely clean. Give him another $38,000 in January, completely clean. The math is simple and the rules are generous. The moment you exceed the annual exclusion by even $1, the landscape shifts entirely. You must now file a gift tax return, Form 709. And here is where most Americans encounter the trap they never saw coming. Form 709 is not merely a reporting document. It is the mechanism that starts a 3-year statute of limitations on the IRS's ability to audit that gift. File it correctly and completely, and the IRS has 3 years to challenge the transaction. After that window closes, they legally cannot. But, and this is the part that costs families real money, if the IRS determines that your Form 709 contains what it classifies as inadequate disclosure, that 3-year clock never begins. Not 3 years, not 10 years. The statute of limitations doesn't exist. The IRS can revisit that gift 20 years from now, 40 years from now, after you're gone, after the recipient is gone, and arrive with a demand for full tax, penalties, and compounded interest. What constitutes inadequate disclosure is broader than most people expect. Writing gift to nephew instead of gift of $18,500 in cash to John Doe, Social Security number ending in 4877. Inadequate. Omitting the fair market value of the asset on the date of transfer. Inadequate. Failing to describe the asset with enough precision for a valuation professional to assess it. Inadequate. The majority of people who complete their own Form 709s complete them inadequately. The IRS has no obligation to notify you of the deficiency. In fact, leaving your disclosure inadequate is structurally advantageous to the agency. It means the file stays permanently auditable, without time constraints, allowing them to return whenever enforcement resources and priorities align. This is not a theoretical edge case. It is the most frequently occurring gift tax trap in the entire U.S. tax code, and it applies to small gifts just as it applies to large ones. Because a modestly sized gift filed incorrectly carries the same unlimited audit exposure as a $1 million transfer. The lifetime estate and gift exemption for 2026 is $15 million per person, established under legislation passed at the end of 2025. Total lifetime gifts below that threshold generate no actual gift tax liability when reported, but they must still be reported, and they must be disclosed correctly. Assuming that a zero tax outcome makes proper disclosure optional has cost American families millions of dollars in back taxes and penalties over the past decade. The 1099K reporting rules for payment applications are now settled after years of regulatory uncertainty. The current threshold, payment apps must issue a 1099-K to you and to the IRS if you receive more than $20,000 in a calendar year and complete more than 200 separate transactions on that platform marked as payments for goods or services. Both conditions must be satisfied simultaneously. Personal transfers between family members marked as non-commercial do not trigger reporting. Spousal transfers do not trigger reporting. Venmo, PayPal, and Cash App all follow this framework. Zelle is different, and the distinction matters. Zelle doesn't technically hold funds. It moves money directly between bank accounts. For that reason, Zelle itself doesn't report transactions. Many people conclude from this that Zelle transfers are invisible to the IRS. That conclusion is incorrect. Your bank observes every Zelle transaction flowing through your account. Your bank is legally required to report patterns it deems suspicious to the Treasury Department's Financial Crimes Enforcement Network, FinCEN. FinCEN shares everything it collects with the IRS. Under Title 31 of the United States Code, Section 5318, your bank is prohibited from informing you that a report has been filed. You'll learn about it only if and when the IRS arrives with questions. A consistent monthly transfer of $15,000 to your adult daughter may never attract attention. A $30,000 Zelle transfer followed by $10,000 a week later, followed by $5,000 3 days after that will almost certainly generate a suspicious activity report at your bank, and you'll have no idea it happened. There's a second threshold worth understanding: the currency transaction report. Any cash deposit or withdrawal exceeding $10,000 at a bank triggers an automatic filing to FinCEN. No discretion, no exceptions, regardless of the legitimacy of the transaction. The IRS accesses this database through the Bank Secrecy Act search tool, without a warrant and without any notification to the account holder. There is one family money move I see cause more unintended legal consequences than almost anything else. It's so common it barely registers as a decision: adding an adult child to your bank account. The logic feels sound. If you become ill or incapacitated, your child can step in, pay bills, and manage things on your behalf. It feels like responsible planning. It feels like love. Under U.S. tax law, it creates a permanent problem. The moment you add your adult child as a joint account holder, the IRS has legal grounds to argue that a portion of the account's assets were gifted to them on the day their name was added. The agency doesn't always pursue this, but if you're ever required to demonstrate otherwise during an audit, during probate, during an inheritance dispute, or during a divorce proceeding, the burden of proof falls on you, and the digital record is permanent. Every deposit flowing through that account becomes partially attributed to the co-owner. Every withdrawal made by your child becomes evidence of account access. If your child takes $10,000 from the joint account to cover a car repair, the IRS can characterize that as either a gift from you or a pre-inheritance distribution. Either framing creates tax exposure. The better mechanism for giving your child access to your finances without creating gift tax implications is a durable power of attorney, which grants management authority without conveying any ownership interest. Gifted property versus inherited property. This distinction costs families more money than almost any other misunderstanding in estate planning, and families walk directly into it constantly. If your mother gives you her home during her lifetime, you inherit her original cost basis. She paid $60,000 for it in 1985. Your basis is $60,000. When you sell it 30 years later for $600,000, you owe capital gains tax on the full $540,000 difference. At the 20% long-term capital gains rate, plus applicable state taxes, plus the 3.8% net investment income tax, that's a bill exceeding $130,000. If instead, she leaves the same house to you in her will at her death, you receive a stepped-up basis. Your cost basis resets to the property's fair market value on the date of her passing. If that value is $600,000 and you sell the following week for $600,000, your capital gain is zero. Your tax is zero. Families transfer real estate to children during their lifetimes, believing they're being generous, simplifying the estate, or avoiding probate. What they're actually doing is converting a stepped-up basis inheritance into a taxable capital gain. Gifting their children a six-figure tax liability the IRS will collect patiently when the property eventually sells. The rule is straightforward. Lifetime gift equals carried basis equals tax upon sale. Inheritance at death equals stepped-up basis equals no tax upon sale. If you can hold an appreciated asset until death, you almost always should. Here are the 5 strategies families use every day, completely legally, to transfer wealth without triggering surveillance, audit flags, or unnecessary tax. Strategy 1. Gift splitting. If you're married, both spouses can each gift the full annual exclusion to the same recipient in the same year. A married couple can transfer $38,000 per recipient annually with no tax and no Form 709 required. A couple with 4 adult children can legally move $152,000 per year to the next generation with zero IRS reporting, year after year. Strategy 2. The direct payment exception. This is one of the most powerful provisions in the tax code and one of the least known outside of estate planning attorneys' offices. If you pay tuition directly to an educational institution or medical expenses directly to a hospital or physician on behalf of another person, the IRS does not classify it as a gift, not partially, entirely. You can pay $100,000 in tuition directly to a university on behalf of your grandchild this year, and it consumes none of your annual exclusion and none of your lifetime exemption. It doesn't appear anywhere on a gift tax return. The single condition: the payment must go directly to the institution. If the money passes through your grandchild's account first and is then used to pay the tuition, it becomes a gift. If you write the check payable to the university, it doesn't exist in the gift tax system. Strategy 3. The 529 5-year election. A 529 education savings account already offers significant tax advantages. A special provision amplifies this further. You can contribute a lump sum to a 529 plan and elect to treat the contribution as if it were distributed evenly over 5 years, meaning a single $95,000 contribution in 2026 is treated as 5 annual gifts of $19,000, entirely within the annual exclusion, requiring only a Form 709 declaration of the 5-year election. The money then grows tax-free and comes out tax-free when used for qualified education expenses. It doesn't appear as a taxable gift in any subsequent year. And under recent legislation, unused 529 balances can now be rolled into a Roth IRA for the beneficiary, up to $35,000 total, so money that doesn't get used for education doesn't disappear. Strategy 4. The Crummy Trust. The name comes from a 1968 court case, not a commentary on the strategy's quality. A crummy trust is an irrevocable trust structured so that each beneficiary receives written notice annually of a short window, typically 30 days, during which they may withdraw that year's contribution. Because the beneficiary has the right to access the funds, the contribution qualifies as a present interest gift and uses your annual exclusion rather than your lifetime exemption. In practice, the beneficiary chooses not to withdraw. The money stays in trust. You fund $19,000 per beneficiary per year. Repeat for 30 years. You've moved $570,000 per beneficiary into trust with zero gift tax, growing in a structure insulated from the beneficiary's creditors, future divorces, and estate, across multiple beneficiaries and multiple generations. This is how substantial family wealth transfers happen quietly and entirely within the rules. Strategy 5. Unlimited spousal transfers. Federal gift tax law treats married spouses as a single economic unit. Transfers between spouses, cash, property, investments, business interests, are not gifts. They're not reportable. They consume no annual exclusion and no lifetime exemption. The practical application: if one spouse holds an appreciated asset they intend to eventually pass to children, transferring it to the other spouse first effectively opens a second annual exclusion and a second lifetime exemption for subsequent gifting, doubling the family's tax-free transfer capacity without any additional filing requirement. Let me give you a real example of what happens when families don't use these strategies. A grandmother in Pennsylvania gave her grandson $90,000 over 4 years to help him through medical school. She didn't know about the annual gift tax exclusion. She filed no Form 709s. She wrote checks directly to her grandson because she loved him and wanted him to become a doctor. 3 years after the final check, her accountant filed her annual income tax return. The IRS algorithm flagged a discrepancy, not in her return, but in her bank records. The system detected large outflows that didn't correspond to her income pattern, cross-referenced against her grandson's account, showing deposits inconsistent with his reported earnings. 2 years passed while the case moved through the IRS system. By the time a determination was reached, the grandmother had died. Her son, executor of her estate, received a bill for $72,000 in back gift tax, penalties, and compounded interest. The original transfers, if properly filed on Form 709s with adequate disclosure, would have generated exactly zero in gift tax. The full $90,000 fell well within her lifetime exemption. She simply never filed the paperwork. That $72,000 bill didn't result from aggressive tax planning or deliberate evasion. It resulted from not knowing what the algorithm was going to see, and not filing the documents that would have made what it saw entirely unremarkable. Here is the reframe that matters most. The IRS AI doesn't process intent. It doesn't register that your motivation was love or generosity or helping someone through a difficult stretch. It processes patterns, and it compares every pattern it sees against a model trained on millions of prior returns to determine whether the behavior looks like someone who filed correctly or someone who didn't. A parent who sends $19,000 to each adult child annually looks entirely normal to the model. A parent who sends $18,999 looks like someone who deliberately structured a transfer to stay $1 below a reporting threshold, which is itself a federal crime under Title 31, regardless of whether any such intent existed. The IRS doesn't have to prove intent. It only needs to see the number. So here is what you do. Stop thinking about what you're allowed to give. Start thinking about what you can document cleanly. Every transfer needs a clear memo. Every gift above the annual exclusion needs a properly completed Form 709 with full disclosure. Every strategy you use needs to be the one the tax code actually built. The direct payment exception, the 529 election, the crummy trust, the gift split, not an improvised workaround. The agency is operating with 27% fewer human employees than it had at the start of 2025. Its response was not to scale back enforcement, it was to scale up the AI. Fewer audits. But the ones that do open are selected by systems that already know what they're looking for before an agent ever opens the file. You cannot hide from the algorithm, but if you use the rules correctly, the algorithm finds nothing worth pursuing. That distinction, being in the database as someone who checked every box rather than someone who didn't, is the difference between protecting your family's wealth and surrendering a third of it for no reason at all. Before you close this video, I want to give you one concrete action to take right now. If you've made any cash transfer, Venmo payment, Zelle transfer, or check to a family member that exceeded $19,000 in a single year, in 2026 or in any prior year, and you did not file a Form 709, that file has no statute of limitations. The IRS can revisit it at any point in the future. The only way to start the clock running is to file a properly completed 709 with full adequate disclosure. That's your immediate action. Find out whether you have unfiled 709s and, if so, get them filed correctly. If you want the complete framework, every rule, every threshold, every strategy covered in this video laid out in a step-by-step reference document, the 2026 Family Money Transfer Checklist is available at the link in the description below. It's free. It covers every transfer method discussed today, the exact Form 709 disclosure standards that satisfy the IRS's adequate disclosure requirement, and the documentation protocol that keeps every family transfer clean, regardless of size. Subscribe if you want this kind of information on a consistent basis. No products, no financial pitches, just the specific mechanics of how the tax code actually operates and how to use it in your family's favor. Share this video with anyone in your life who has been sending money to family members, parents helping adult children, grandparents funding education, anyone who has written a check to a relative and assumed the transaction was private. The grandmother in Pennsylvania didn't lose $72,000 because she did anything wrong. She lost it because nobody told her what the algorithm was going to see. One share from you could prevent exactly that outcome for someone you care about. The tax code was never designed to penalize families for helping each other. It was designed to reward families who plan. The 129 AI programs running at the IRS right now are not looking for love. They're looking for patterns that don't have documentation attached to them. Give every transfer a document. File every 709 correctly. Use the rules that already exist in your favor. And from this point forward, every transaction you make will be in the database as something the algorithm looked at and moved on from. That's exactly where you want to be.